Welcome to this Killick Explains video, and welcome to a video on a topic that's exploded into the financial headlines recently, so-called meme stocks, and the battle between retail investors and the big hedge funds of Wall Street. So what are these things, and what should investors make of them? Now the background is what? Well, in a nutshell, we've seen a huge battle erupt in financial markets that's attracted all kinds of headlines, articles and analysis. Lined up on the one side were retail investors and on the other, institutions, loosely called Wall Street. And the battleground was these things called meme stocks. So, a working definition. Now people are still scrambling to come up with a definition of these things, but something like a label given to stocks, or stonks as they're known on the web at the moment, that rocket in value for no obvious conventional reason. So the finances of the company don't indicate that it should rocket in value. The brand, share and so on doesn't particularly indicate that it should, but nonetheless the stocks roar off. And examples have included GameStop. We're talking gains in a very short space of time, a matter of days, of a couple of 1,000% in some cases here. AMC, BlackBerry and Tootsie Roll. The thing that links them together is there's no obvious reason why they would rocket, other than the sheer volume of money that's suddenly put behind them. And they're deemed pure sentiment plays as such by mainstream investors, so you won't make an investment case for these off the back of standard ratio analysis, any of that. It is a pure momentum trade. Now, who are the key battlefield players that have set up this fight, as it's been pitched, between retail investors on the one hand, small investors, and the much bigger hedge funds of Wall Street? Well, I've given you some clues there. So retail investors with money to spare and access to the market via apps such as Robinhood are playing a huge part. And a lot of them are getting their information from sites like Reddit. So they're using the internet, getting together in chat rooms, sharing ideas, banding together, and then launching, if you like, an assault on particular companies that are out of favour. Helping them, of course, are the central banks, which have been creating liquidity through money printing and so on. All of that liquidity has been looking for a home, and some of it has undoubtedly spilled into equity markets. On top of that, of course, many investors are not spending money on commuting, on holidays, on going out. They can't even play sports bets with the same frequency perhaps they used to, so they're looking for somewhere to be able to make money. And then on the other side, you've got hedge funds who have a reputation. They're called long short. Often it's the short bit we're interested in, for basically picking on companies that are weak financially and trying to drive the stock price down with a view to making money. So bulls on the one side, if you want to see it that way, bears on the other. Or people with a point to prove to Wall Street as it's being billed against Wall Street itself. Now, what are the motives for what's going on here? Well, in a nutshell, some people simply on the Robinhood and Reddit side of the fence want to prove Wall Street wrong and make money on unloved stocks. Some of these stocks have risen 1,000 or 2% in a very short space of time. They're also, some think, interested in making a point. A lot of people think that short selling, what hedge funds do, driving share prices down as it's seen, is unethical. It's not illegal, but it's unethical. There's proving a point there. And the conspiracy theorists out there think their objective might be even broader than that. It is to destabilise the very financial markets in which all these activities normally take place. So, how do hedge funds try and make money, and what's gone wrong for them when faced with this wall of buying pressure in these smaller stocks? Well, the short squeeze, as I've called it, is hedge funds would normally borrow stock and sell it on. It's a mechanism called short selling. If the price falls, they can then buy it back cheaper, for less than they sold it at, bank again, and return it to the original lender. But if the price rises while they have an open short position, in other words, between the sale and the repurchase, then they face a sudden scramble to find stock to close out their positions and honour the original loan deal. There are other ways to short stocks, using futures, using spread bets, but short selling involves the shares themselves. Now, as an example of what can go wrong, and this is precisely what the retail army through Robinhood and Reddit and so on were hoping would go wrong. So what can go wrong? A hedge fund short sells 1,000 shares at $1 each, let's say. It thinks the underlying company is weak, it thinks they've got further to fall. The price actually then rises to $10 whilst that short position is open. In essence, closing the position will generate a loss of at least $9,000 as the hedge fund scrambles around to find the stock it'll need, and that may not be easy if people are not willing to sell it, pass it on to close the position. Now, why did the market freeze? So at the end of last week, something odd happened, which was that Robinhood effectively suspended trading in some of these meme stocks. And a lot of people smelt a rat, they sort of cried foul, if you like. But actually what's happening there is a mechanism that is well known within the market. So brokers such as Robinhood must maintain deposits with clearing houses, the DTCC in the US being the big one. It's also known as margin. And what margin does is it's designed to protect essentially the market from buyers either not paying for stocks, sellers not delivering them. It's like a security deposit. It's returnable, it earns a bit of interest, but it's normally levied on both sides of a transaction because at any point either the buyer or the seller might default, pay late and so on. And remember, worth bearing in mind that most transactions within financial markets involving listed shares have to be settled, that's closed out, done and dusted in 2 business days, T+2. So it protects counterparties against large losses and defaults, and essentially Robinhood stopped trading in certain stocks, these meme stocks, while it tapped further capital in order to support open trades. In other words, its own requirements at the DTCC altered fairly quickly, and it felt the only way it could protect itself against, for example, one of these stock prices completely collapsing was to suspend trading. So what are the lessons for investors from all of this? Well, number one, avoid single stock bets. That is a message that I've hammered home in other videos on other topics. Number two, bear in mind that shorting is not illegal and it's perceived as high risk. In other words, as I've demonstrated hopefully, if you short sell a stock as a hedge fund and it starts rising, your losses are actually unlimited, whereas the buyer of a stock can face big losses, but only up to 100% of the amount they commit. And as such, short sellers do take on a lot of risk. And although what they do is seen in some quarters as unethical, others would say if a company's in trouble, if it's not being well run, it should be taken out of the market so that the capital invested in it can be put to more productive use. Avoid this battlefield unless you can afford to lose your investment is my overall message. In other words, I'm not a believer in single stock bets on the upside, let's say. Most people should not be out in the market trying to short using spread bets or any other mechanism. So this is a battlefield to watch. It could indicate the shoeshine boy moment for the bull market of the last 10 years. Whether or not that's true is a debate for another day, but I would basically steer fairly clear. Any questions on what's a big topic and lots of jargon? editor@killick.com. If you'd like to watch videos related to this topic, which cover some of the issues around hedge funds I've mentioned, then it's killick.com/learn. And again, any questions around any guides that we also produce on how to invest in equities, editor@killick.com would be the good place to start.